Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to the ETF Market Insights. This is Kevin Prince. I'm going to be your host today. I'm sitting in for Aaron Allen, who actually is sick and has COVID. Yes, it is still going around. Now, today's topic, we want to have it for you today, is on the ETF Outlook. We had released a report from BMO ETFs on the market for 2023 as an outlook for the ETF industry. And joining me today is Mark Reyes, Head of Product for BMO Global Asset Management, as well leads up our ETFs. He was the core author of the actual report. So thanks for joining me, Mark.
Thanks for having me, Kevin. Appreciate it.
If you've been in these shows in the past, you know that we're not going to provide you specific recommendations, nor are we going to provide you specific advice. Our goal today is to provide you insights on the overall market with a tilt towards exchange-traded funds. Now, if you've been here also in the past, and thank you for coming back, please take the time and effort to subscribe. If you're listening to this and watching this on YouTube, we would really appreciate that. As well as if you want to let some of your friends and family know about this show, we appreciate that too. With that, let's get into the core topic today, Mark. One thing we'll do is we'll start off with a little bit of background on what happened in 2022 as we lay up to the conversation for 2023. And certainly we've seen another strong year for ETF flows in the entire industry. I think the overall number is around $35 billion went into ETFs last year, taking the overall ETF industry in Canada well above that $300 billion mark. Hand in hand with it, which is really interesting, you saw a lot of new ETFs come in the marketplace. The number I'm working with is about 150 net new ETFs, taking the industry up to around well over 1,300 of them. Now, I really like that because what it's really showing you is the innovation continues to come into the market. And when I look back at what happened over the 14 years, for example, when BMO ETFs has been in the marketplace, is that innovation had brought in new ways to build portfolios and enhance portfolios across the board. And I think as new ETFs come into the marketplace, this trend of building better portfolios continues going forward. Mark, any thoughts on that?
No, I think you've said it well, Kevin. Certainly when you consider the market volatility and everything that went on in 2022, the fact that ETFs once again had strong positive net flows, I think is a great acclamation point for ETFs. I think we'll get into the details a little bit more about where, but we did see flows across the board. And what I think about more than anything there is, people understand the use of ETFs as portfolio building blocks, but what a market like 2022 shows is that people also use them as effective tools to rebalance portfolios, and you really see that come through as people were trying to respond and react to a lot of different things going on. An ETF is a great vehicle to quickly pivot a portfolio. So that was certainly a key theme throughout the year.
Thanks for that, Mark. And you're right, taking a little bit about trends we've also seen in the marketplace was, flows by asset class. And one of the things we saw last year is a good solid flows into fixed income ETFs. Yes, we all know the market was challenging for fixed income last year, but certainly reinforced the demand and the need for an ETF solution to get exposure to that part of the market or that asset class. I think if we looked at the overall numbers, around 54% of the overall flows last year went into fixed income ETFs. Another key area where we saw strong flows last year was inside of the cash equivalent ETFs. And I think that's related towards what happened in the marketplace last year where people are looking for places kind of to park. But I will note that equity ETF flows also maintained positive flows last year too. So a good base market and hopefully a good way to build for 2023. Keeping going through here a bit more, a little bit of background on what also happened from a BMO ETF perspective in the marketplace. I'm going to highlight that we did about $8.4 billion in ETF flows last year, making it about 25% of the overall ETF market now for assets under management. And I will highlight that it's a 12th year in a row of us leading the industry for net new assets growth, that is, in sales of ETFs. Keeping going here, let me turn to Mark, and I want to talk about now parts of the actual Outlook report you put together. One key consideration we certainly saw last year, and a good discussion for this year, is regards to inflation. We've seen it start to tilt off. Mark, let me get your thoughts in regards towards inflation, but also get your thoughts about ways people can look to mitigate inflation. Maybe we'll utilize an ETF wrapper, please.
Sure. I think people right now are pleasantly happy with the direction that inflation is going. However, if we went back, 12, 18 or so months and we told you that inflation was going to be up above 6%, I think most people would be extremely shocked. So, it's funny how quickly our mindsets can shift gears on that front. But certainly trending in the right direction now. We've, of course, seen a lot of aggressive activity by the central banks to try to bring it under control, resulting in, very quick and very rapid rise in the overnight interest rates, and of course that's played out across the yield curve. But not just fixed income, of course, having a big impact on growth equities as well, that are kind of based on future cash flows. So, is inflation improving? Yes. Is it gone? No. So it's certainly something that we're dealing with in portfolios, and is probably still going to be the #1 theme through most of 2023. If you look at some of the break-evens on inflation-protected bonds, they're expecting inflation to come down very rapidly. Where, it'd be nice if that's the case, but I'm going to bet there's probably going to be a couple of bumps along the way. So as you think about that, there's types of differentiated products that can really help out your portfolio. So the first one that comes up is global infrastructure. So something like BMO's global infrastructure ETFs at GI. And why do I like infrastructure? Simply because a lot of their contracts are in fact tied to inflation. So there's an inflation clause in the contracts, which really helps out those underlying assets. And you see that in the performance of ZGI last year. A new product that we've brought out, staying with the inflation theme, is global agriculture, ticker ZEAT or ZEAT. Again, you're thinking about companies that sort of have the ability to pass on inflation price increases down the chain. So that's something that, okay, once again, you see a really differentiated return in 2022 relative to the broader markets. And of course, energy was a story in 2021, continued in 2022. What's going to be interesting there is with China reopening, demand story, we'll see how that all plays out. But certainly energy, if you look at a sector basis, is probably the most differentiated thing you can find in 2022. So the BMO Equal Weight Oil and Gas ETF, ticker ZEO, was actually our best performing ETF in 2022, and it wasn't even close. So, different ideas there that you can use around your portfolio. Building in some inflation sensitive satellites, I think is something that's, if you haven't done it already, something that's quite prudent. Thanks.
Thanks for that, Mark. And then just let me stay a little bit longer with ZGI if we can, or global infrastructure. You certainly mentioned that as a theme. Talk to us a little bit more about, that as a good complement to one's portfolio and how that works as a complement in the backdrop of inflation, please.
Yeah, and I'll even give it a broader backdrop of alternatives, because when people see bad markets, they want alternatives, they want differentiated performance. Well, what is ZGI, or a global infrastructure ETF? It's exposure to the infrastructure asset class, but through a listed ticker, which holds listed securities. So in my mind, you're kind of getting the best of both worlds. You're getting the underlying exposure, but you're getting the liquidity and the tradability of the ETF. And if you look at the performance chart here, a little hard to see, but What it shows you is, again, relative to broad equities and fixed income, global infrastructure really stood apart last year as something that is better able to handle inflation. So when you start thinking about alternatives and real assets, the fact that we can offer that type of exposure with a listed ticker, I think that's a real benefit to investors and portfolio builders.
Again, and it speaks towards, innovation, the newer solutions coming out in infrastructure, as well as this, which is over 10 years old, ZGI. Mark, let's just stay with some other theme. We can revisit a different theme. One of the themes you talk about, of course, is covered calls and the demand and the utilization of covered calls. Talk to us a bit about why that fits within people's portfolios. And then second part of that, what are some of the key considerations people should look at when selecting a covered call, please?
Sure, and covered calls certainly were front and center in 2022 as people look to increase the cash flow from their portfolios, somewhat thinking about inflation, but also thinking about the challenges that we all saw in fixed income in 2022. So trying to get more cash flow from your equity book is certainly something that makes sense. And you look at that pie chart where BMO is doing quite well, BMO ETFs. I really think it's a couple of different things. One, it's our tenure in the space, where we launched our first covered call, the bank's covered calls at WB way back in 2011. So we've got the tenure, we've got the history, we've seen market cycles. So we know how to run these portfolios. But two, it's that combination of cash flow and growth, where without getting into the details, we kind of keep a lighter touch on the options, which allows the underlying portfolio to participate in the markets. And you see that with our 10-year plus history there. So for investors, trying to stay ahead of inflation, looking for more cash flow, maybe a little bit lower risk compared to the underlying because of the covered call strategy. There's a lot of appealing aspects to that right now. And when you're in a bit of a wait and see mode on equities, enhanced income or covered calls is something you can certainly look at. So definitely a key theme last year and heading into 2023.
Thanks for that, Mark. Let me dive into another area you just touched on before, but certainly was energy. So, there's a big story last year. Talk us about energy and the investor's mindset. But I guess more thoughts I wouldn't mind get for you is, what do you think of does it have more legs to go going forward? And last but not least, what are some of the key factors people should think about when they look at investing in energy on a go-forward basis?
Well, I do think you want to start with the price of a barrel of oil and where you think that's going. And, there's pretty constructive views on that right now. But in our case, for ZEO, which I mentioned earlier, we're investing in energy sector companies. So you want to be thinking about the companies within that portfolio. And what's going on there is quite simply those companies are enjoying life right now. They're flush with cash. So you're seeing increasing dividends. So that's always great to see payout to investors. It's also going to open them up potentially more medium term into more investment. So it's really positive for the companies when they get a sustained higher oil price, and it sort of becomes something that they can embed into their company strategy. So that's a huge positive. So looking forward, we're still very constructive on the sector, on the space. There's a lot of macro that supports it as well. But I think the important thing is that the companies are in a very healthy position right now. So combine that with still some unease and uncertainty around inflation, I do think that energy is still a valuable tool for portfolios. So looking ahead, pretty comfortable still being in this space.
Thanks for that, Mark. Now, one of the things I was mentioning at the start was fixed income and the demand for fixed income in through ETFs. Now, let's take a little look on maybe a go-forward basis here, Mark, because it certainly was a challenging year last year for fixed income. And, you know, it's also maybe made people think a little bit different about portfolio construction too. Maybe you can talk to us a little bit more about what your thoughts are on fixed income on a go-forward basis, and maybe the portfolio construction challenges, and talk us through that, please.
Sure. Well, we saw the charts at the beginning where it was a strong year for fixed income ETFs. I think that makes a lot of sense. Number one is convenience. So people that hold bonds or bond portfolios and trying to do something with that in 2022, they maybe ran into some liquidity or trading issues. So using an ETF is a great way to navigate the fixed income market first and foremost. So I view them as, you know, a real convenience tool. But if I look at the market itself, now that yields have essentially come off the floor, you're really getting two benefits. Number one, you're of course getting that yield in your portfolio, which is what you wanted from your fixed income, but you weren't getting in years prior. And two, you get a better buffer to future volatility because of that yield, right? So when you start earning, let's call it 4-ish%, it's probably out of date by the time it comes out of my mouth, but it's something in or around there. You know, if you suddenly get any kind of price volatility, that yield provides you a bit more protection compared to where we were when yields were so low, there really was no protection. So, you know, if you've come through the fixed income market and you've experienced the pain, there's been a reset here, and fixed income is now much more able to essentially deliver the benefits that you expect out of it, which is yield and a measure of stability, which certainly wasn't there in 2022. So a lot more positive looking ahead on fixed income. You mentioned off the top, certainly a lot of movement towards the cash trade. I think people now are starting to be more willing to look at longer or full market duration, maybe not there yet, maybe being selective about it. But if they were rushing for the exits last year, I think that story at this point is starting to turn. And again, using fixed income ETFs is a great way to navigate the market.
Thanks for that, Mark. And when you're talking about duration, I think you're really talking about extending the term. And that's one of the nice things about ETFs is the choices in different types of ETFs, short-term, medium-term, long-term. Certainly you're seeing a lot more people have appetite to extend the term on a go-forward basis. Hey, Mark, staying with the markets from last year, but also reflecting on the future, what are the areas, I mean, we did look at the equity markets. They also had a challenging year last year, with the exception of energy, which you already highlighted. One of the more challenging areas of the marketplace was anything that had more of a growth element to it, or a technology element. You know, give us some thoughts in regards towards that on a go-forward basis, please.
Yeah, and this is the area of the market that was probably hardest hit by the rise of inflation, because why? These new technology or new economy companies are certainly being valued on future cash flows. So your discount cash flow model, now that you assume a higher discount rate, certainly that valuation starts to drop in a hurry because all your cash flows are out in the future. So that's, you know, the primary thing that hit a lot of these companies. They'd also had a great run up post-COVID as well. So, you know, if you look at it longer term, the story changes, but certainly 2022 was rough. And so that is certainly something that's hit the market pretty hard. However, for those that were thinking that these growth companies were overvalued and were proven right by markets in 2022, there's an opportunity going forward. And quite frankly, if we have persistent inflation and you need to get your investments working for you, you know, having an element of growth within your portfolio, despite being burned on it in 2022, you've got to have that longer term view, and it's got a place in your portfolio. So there's a lot of opportunity now going forward that maybe was less apparent 12 months ago in this space. So there's lots of ETFs there that you could be thinking about, something like our BMO NASDAQ 100 ETF, either ZNQ or ZQQ for the hedge, or our new ARK Invest ETFs, the innovation ETFs like ARKK. There's lots of different directions you could go for growth. Just make sure you're taking a real long-term view on it because there will be bumps along the way.
Thanks, Mark. That's some pretty good insight there. Appreciate that. Now, one of the areas we saw that worked well last year is low volatility in regards towards more of a defensive factor. Give us your thoughts kind of more about the factor-based ETFs. And of course, these are ETFs that are not following the broad-based traditional indexes, but have more of a objective-based approach. But give us your thoughts in regards towards factor-based ETFs on a go-forward basis, and then maybe touch a little bit, if you can, on low volatility, please.
Sure, and it was quite a story with factors in 2022, and that's probably persisted into 2023, although who knows, we might see a flip later on in the year. But low volatility was definitely one of the leading stories. What does low volatility do? You're trying to pick defensive names within the portfolio. So like our BMO Canadian Low Volatility ETF, ticker ZLB, is certainly something that's well known in the marketplace. In the US, our US low vol, ticker ZLU, really outperformed the market. So that was quite an interesting story for investors. And so you're looking for defensive names. You're probably allocating away from the high growth sectors towards the less growthy sectors, but as well within sectors, you're picking the more defensive names. So in a market like 2022, that certainly came through. The other one I'll mention is dividend here. When you have a market where cash is king, mature dividend paying companies certainly outperform. So that's the other factor that really did well in the past year. The one that was probably a surprise was quality underperforming. I think quality has been carrying an overweight to technology. So despite being in some higher quality technology names, probably still got caught by that a fair bit. So that's a bit of a surprise and maybe an opportunity in 2023. But when the theme of the day was being defensive, low volatility in dividend certainly led the way in terms of factor exposures.
Thanks, Mark. And it's good to see that the respective factor-based ETFs are speaking or actually delivering on that objective over time. That is not all the time, but over time. It's good to see that. Mark, still staying with other trends. One of the trends, of course, we saw was from last year, the growth in the asset allocation ETFs, or these all-in-one solution sets out there. Brought in about $1.8 billion last year. So healthy flows, and certainly I think a lot of investors are looking for kind of a core solution for their portfolio, or a simple basket approach to bringing different types of ETFs and different asset mixes, as well as different geographic mixes into there. Since ETFs have launched in this space of these asset allocations, I'm also seeing that there's been some tremendous growth, not only just last year, but roughly about a little over $15 billion has moved towards these type of ETFs, certainly showing investors looking for that kind of balanced approach to investing, or very much a diversified approach for investing. But Mark, let me come to you. Now that the pandemic maybe hopefully is passed and we're starting to maybe move to more normalized rates on a go-forward basis, what's your thoughts in regards towards a 60-40 portfolio that was being challenged last year on maybe a go-forward basis, or the traditional asset mixes on a go-forward basis beyond just the balanced portfolio that I'm trying to say?
Sure. Well, Kevin, I think when we look at these ETFs, they add discipline to your portfolio. They give you that core exposure across markets that you need, that if you're doing things around it, suddenly your portfolio starts to make a lot more sense. So seeing the success in this marketplace, not surprised at all. And when you compare it to mutual funds, where of course balanced mutual funds have been a massive part of the market for years and years and years, a long way to go on the ETF front to catch up in terms of percentage that way. So in terms of the mixes themselves, yeah, we heard quite a bit about, is the 60-40 dead? Certainly the 60-40 had a tough year, but the tough year was on both equity and fixed income. So now fixed income has gone through what I'll call a reset. I think you are going to see continued use of that 60-40. What we are seeing with balanced ETFs is more use of the 80-20, so the growth portfolios. That might be a skew with newer investors, sometimes with direct investors, but we are certainly seeing a lot more interest in 80-20. That's been picking up. But again, with fixed income now in a much better place, the 60-40, in my mind at least, still will remain central to balanced portfolios. And the other thing I'll mention here that we've done is bring out payout series as well. So .Ts, as we call them. This is a new development from BMO ETFs. Again, bringing out that convenience. So if you're someone who's transitioning from growth towards payout and retirement, if we know the T6 series from mutual funds, here we go on the ETF side. The portfolio is giving you that payment, which means over time you're getting the yield off the portfolio plus converting some of your investment into that convenient payout. So I think this is going to be a really interesting and important element if we think about retirement and using ETFs to build retirement portfolios going forward. Thanks.
I have to agree, and I'm glad that we're bringing more innovation to the marketplace and yet a net new way to build portfolios. In this case, that 6% annual payout, paid out monthly, that is, and your combination of the underlying plus whatever it needs to come out of the underlying, the actual portion of the portfolio. Hey, Mark, let me, before we close off, I want to get some of your final thoughts here. Final thoughts on the year ahead, and then maybe too, BMO ETFs launched some brand new ETFs last year. Maybe you can touch on those too, please. Or last week, sorry.
Sure, thanks, Kevin. So new ETFs, yeah, we've brought out, I think, some pretty thoughtful products where we're considering cash flow with new covered calls and energy, ZWEN, and healthcare, ZWHC. I mentioned the global agriculture already, ZEAT. But as well, US fixed income. We were asked to bring out broad market and full market tips. So those have been good additions. And I mentioned the .T, so adding to that suite with our growth portfolio, so the 80-20 portfolio. So pretty happy with that list that's just come out. If we look ahead to 2023, it's going to be a question of how pessimistic is the market, or is it going to start to break through? We've seen a great January. We've seen some positive return numbers. Again, if inflation continues trending down, even when we saw the Fed still increase the overnight rate because there was a hint of calmness ahead, the market still reacted pretty positively. So I think we're in for a better story in 2023. A lot of cash on the sidelines that perhaps will get redeployed over the year. So a great opportunity to be looking at ETFs as vehicles to put that money to work.
Have to agree. Hopefully another good year for the ETF industry as a whole. Hey, Mark, I'm going to shift a little gears. Hopefully I can have you stay with me a little bit further. The goal here now is to answer some questions that came in from some of the audience. So let me shift gears and do that. First question that came in, and Mark has head of products, I'm sure you're going to know the answer to this one, but looking to get an understanding of the differences in some of the indexes out there. So in this case, the TSX 60 index, as well as the TSX Cap Composite Index, and then the FTSE index out there too, also on the Canadian marketplace. Maybe give us some differences in the those type of indexes, and then the different exposures, please.
Sure. Well, you are looking at broad exposures to the Canadian marketplace, so there's of course going to be a fair amount of similarity here. The composite is the index that I think everyone tracks and knows, the TSX composite. So I do think if you're looking for the return of the Canadian marketplace, that's where you want to start. That's the well-known market followed index. That's what we follow on our ZCN ETF. What is the 60? The 60 is actually modeled off the composite, but of course only includes 60 names. So it's trying to come close to that exposure with less names. There is a little bit of friction because it's kind of hard to exactly match. But essentially, if you can get the whole market 200 plus names as opposed to 60, I think there's some benefits of looking at the composite there. And then if you were to go to another index provider, FTSE or anyone else, you're going to get, some minor differences to the portfolio, which are going to cause some smaller return differences. So again, if you're looking to capture market returns, I would start by looking at the known broad benchmark.
Thanks for that, Mark. And I'll quickly highlight too, if you want to see any of the holdings of any of the BMO ETFs, we post all of our holdings on our website for these respective, for the CAP Composite Index and many of our indexes too. Mark, let me stay with you a bit more. In this case, we're going to talk a little bit about more about covered calls, certainly a topic that keeps coming up. In this case, look at covered calls in those times when there's sharp downturns in the marketplace. Can you recover that losing part if you're trying to sustain the posted yield? So I guess when you're looking at this, can you talk to us not only about how you're recovering the losses, but maybe the different types of covered call ETFs out there and how they would regain that loss if they can regain that loss?
Sure. So as the question points out, you are exposed to the underlying companies. So when markets turn down, you move down with them. That call premium provides a slight bit of protection, but if markets are moving significantly, that's not going to cover the loss that the markets might deliver. So what you need to be able to do is participate on upside as markets recover. So what you want to think about is how is that covered call strategy being implemented? So with BMO ETFs, we only write on half the portfolio. We write out of the money short dated options. So the portfolio has a lot of opportunity to participate in market upside and therefore recover. If you were to look across the street, you'll see different ways of implementing that covered call overlay. And if someone happens to be writing on more of the portfolio or perhaps writing at the money, well, then that participation in the market recovery slips. So it's something to watch out for. If you see outsized yields, you want to really understand how they're getting that yield and whether there is a risk to your capital going forward. And so, I spoke to covered calls before. I think that's the real importance of having a track record in the space. And the fact that we can point to 10 years plus really should give investors confidence when they look at BMO covered call ETFs.
Thanks for that, Mark. Good insight there and good tips to take a look at the respective provider and look a little bit underneath the hood, as well as understand their strategy and what it means towards you and your performance, as well as your yield. With that, Mark, I'm going to say thank you for joining us once again. It's always a pleasure to have you on this show and sharing your insights. Anybody who wants to get a copy of the Outlook report that we've been talking about, you can get that off the ETF Market Insights website itself, or there's lots of press releases around it too. Just look at the respective press releases. You get access to it that way too. And let me give you a quick little highlight what's going to come on next week. We did talk today about inflation protected ETFs. So we're going to have a focus in regards towards that, because I certainly had a good discussion around inflation. But in addition, we're going to bring in there a discussion in regards towards agriculture too. We have BMO Capital Markets joining us, as well as from our BMO ETFs desk joining us too. And back in the main stage will be Aaron. So look forward to having you join us next week. Between now and then, have a good week ahead. Cheers.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.